The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Joining us now is everyone's favorite shark, of course. He's chairman of O'Leary Ventures. He runs O Shares, and this past week he's, I'm sure, saying OMG. Good morning, Kevin O'Leary.
Great to be here. Thank you.
Glad to have you. Glad to have you back. Before we get into some of the things that happened this past week, do you think that this is it? Do you think that that we've seen the bottom? We're at about 16 and change. We've when it comes to Bitcoin, do you think that this is all that there is, or do you think that potentially there might be some weakness here in the markets and that people might lose some faith in the next few weeks and sell off their holdings?
I think what we need now is to flush out the auxiliary collapses that are going to occur because of accounts that, let's say, public mining companies had with FTX or other hedge funds that have obviously over the weekend gone to zero in their accounts. Now, first, I have some disclosures here. Okay, number one, I'm a paid spokesperson of FTX, so I've been dealing with their management. I've spoken to Sam last week on Thursday. I also have corporate accounts in FTX. I'm also a shareholder of FTX International and FTX US. So now we got that out of the way. I just want to make sure I'm being very transparent on this. But we're not finished with the collateral damage. And so to your question, this is a bottoming process. An event like this is very important because it's finally going to have several impacts in areas that we need. It's going to accelerate regulation, number one. As we speak, I'm at the governor's conference in Orlando. This is topic number one in financial services. The amount of discussion going on last night and certainly today about this situation is going to move. It's definitely going to move legislation in the House. There's no question about that. This is a defining moment. But what we don't know is how many other dominoes are going to fall yet. We need that to finish out.
You mentioned you spoke to Sam Bankman-Fried last Thursday. What was that conversation like? What was the mood, and did you learn anything?
Yeah, let me explain the context of that conversation. On Wednesday of last week, the whole world knew that there was a liquidity issue at FTX and that the hold on the balance sheet was somewhere between $6 and $8 billion. Now, I work in the indexing market for sovereign wealth and pension, and so we were getting a lot of inbound requests about information about the situation because that's the kind of money that an institution or a sovereign wealth fund can put to work if they thought there was an interesting opportunity. And in financial services, illiquidity events or liquidity events like this can be interesting investment opportunities if you think it's a legitimate investment and it's not going to issues with the regulator. So the timeline of that conversation is I put a message into FTX. I wanted to confirm the amount being requested. Was it going to be 6 or 8? Sam called me back, very, standard conversation. He was, rational, and we had that conversation about confirming what the amount was going to be. The amount was $8 billion. That's what they were looking for. So I went back to these various entities that were asking me about it, and by that time, the SEC chair was on the air around the world. I think the network was CNBC, and he made it clear that they were going to come down hard on this situation. So the minute that occurred, that was the end of any sovereign wealth fund's interest because they index in the S&P 500. They have to be compliant with the SEC. And so, if you're a sovereign wealth fund making $250 million a day, the only market you can put it into to park it is the S&P. It's liquid enough to absorb that. So they don't make moves against U.S. regulators. And that was, I think, the last. I know that was the last time I talked to Sam, and then the other events unfolded as you saw. There was no way to get that $8 billion onto the balance sheet of FTX with the regulator hovering overhead.
So, Kevin, you mentioned you were a brand ambassador for FTX. You promoted FTX. I imagine, you were really into compliance and you felt that FTX was up to regulatory standards. But in the end, do you feel duped, lied to, or betrayed?
I'm a big boy. I've seen this movie before. I will say on a personal level, and I don't think if you talk to 10 people that knew Sam, 9 of them are going to say what a wonderful guy he was. And I'm one of those. I just think he's a very interesting individual. Over time, we'll peel this onion, find out what happened. I don't think that guy has an evil bone in his body. I've met his parents. They're compliance lawyers at Stanford. Wonderful people, very philanthropic. It was those, it's meeting the team there that gave me the confidence to get involved with this, because I wanted a platform, a robust platform where my compliance department, my accounting, my financial people, and my own operating company and our auditors could look at this and say, all right, we can understand the transactions, we can account for it, and we can report to regulators as we must. And we did. The truth is the FTX platform was very robust. It was very well designed. Hundreds of millions of dollars went into making that. And that's why there was sovereign interest and pension interest in the platform itself, because at that time, just before the gates came down, you got to remember, all of these funds got gated, towards the end of the week. And there they are sitting there. If somebody had provided the liquidity, and here's the interesting debate that was going on. Let me share this with you. So let's say your sovereign wealth fund, $8 billion is a rounding error for you. Do you really need $8 billion? And let's say what was on the table in the deal was ownership of FTX, which was on the table. So for whatever the amount is to keep FTX liquid and compliant, you could own it. Now, if you think about Binance and FTX, that's about 82% of the world's exchange. I mean, that's it. And that's a big, big chunk. So there was interest. And here's the real debate that went on. It really wasn't $8 billion required, because if you could put in, let's say, $2 or $3 billion, then open the gates and let anybody that wanted to get out, get out. The minute you open a gate, some large percentage doesn't use the gate because they feel they're safe and now can transact again, and they've got backing. That was the debate going on in the later hours of Thursday of last week. My guesstimate, and it's only a guesstimate, is the number that could have cleared FTX and kept it solvent would be about $3.5, $4 billion, which is not a heavy price to pay for what had been built up over those years. However, once you go into a situation where regulators are coming in and the whole thing goes south, there's nothing you can do about that. But for about 12 hours, that was an interesting conversation going on all around the world.
So, Kevin, as you know, they filed for bankruptcy. So, first of all, are you still a paid spokesperson after the bankruptcy? I mean, have you talked to the new management? Or now are you a creditor for FTX? And, your shares obviously are in jeopardy, your ownership shares because of the bankruptcy. So, I mean, do you still have that relationship? Have you talked to the new CEO of FTX yet about your relationship?
No, I haven't, but I know the existing management. There's no point in having those conversations right now. I mean, the only conversation I've had is with my lawyers and my auditors, as every institution's had those conversations over the weekend. We are going to go through a bankruptcy process. There is precedent for this. You can go back and look at Mount Ott. It took 4.5 years, and because that was also multinational. So you've got the shares, my shares in FTX International, my shares in FTX US. Well, we're going to have to write those down to zero, most likely. And that happens, This is not my first. It's not my first bad investment. It won't be my last, but luckily I make more good ones than bad ones. And so that's the way I look at it.
About that, because you mentioned that he's the son of compliance lawyers. Look, and my father was a great electrical engineer, and his father too. I'm not allowed near a plug. There was a thing about their governance at at FTX that was very peculiar. There was no CFO, there was no board of directors. It seemed that management was kind of murky, and yet they were able to raise hundreds of millions of dollars. Do you think that the failure in due diligence and the failure to ask the questions and the failure of people to say, hey, you know what, this doesn't look the way we normally invest in companies. Why did so many people give Sam Bankman-Fried a pass when it came to governance, when it came to corporate governance and the structure and management? Is it just because of his parents being compliance lawyers? I mean, it's not genetic. He didn't go to law school as far as I could tell.
You know, they didn't raise hundreds of millions. They raised billions. The cap table has pretty well every significant financial services behemoth company on it. It was considered for a while to be the premier, compliant platform, in the sense that we had an American running it, an American creating it. That gave some people some confidence, maybe ill-advised. However, Sam Bankman-Fried is an American, and he's well known, and he is, no question, brilliant. I mean, when it comes to understanding blockchain and cryptocurrencies, very few people had his knowledge and his ability to build code around it. Remember, Serum is one of his projects as well. So he's well known in the community and a founder, and for a while, saving lots of other entities by putting cash into them. Where that cash came from is under question now, obviously. But the bigger question about this from the institutional perspective, and we're having this dialogue even today, is this does not kill crypto. This is one event that helps stabilize crypto. There's going to be a silver lining to this disaster. There's no question about it. It'll be called regulation. And I'll tell you why. It's not new regulation required here. You can look at any broker-dealer exchange tied in the U.S. to stocks or bonds or futures or commodities and have regulations that are protecting investors in the U.S. market. So it's not a big stretch to have the regulators finally say, we're going to apply that to crypto exchanges the same way. And I think that's going to happen.
But the issue ultimately is that the structure of FTX, the lack of simple management and the way a board normally runs and a chairman, CEO, et cetera, didn't exist there. It seems there was no CFO. There was no regular structure. Was there a myth, the wonderkind myth? Why is everyone trusting anyone under 35? I mean, there's the old saying, don't trust anyone over 30. But in this case, I mean, we're seeing, Do Kwon was in his early 30s and a Canadian, my understanding. So what do we have here? What went wrong with all these investors that they put all that money in a structure that just didn't seem to be ordinary or regular?
Well, you're absolutely right to ask these questions, and I guarantee you it will be litigated in the years ahead. By the time this is over, because of the nature of the chain itself, we'll know where that money went. We may not know the owner of the wallet, but we're going to find out where every single token went by the time this is over. And that's probably a good thing at the end of the day. But the questions you're asking are the right questions. And so going forward you have to ask yourself, what institution is going to put significant capital, because I've had this conversation early this morning, into any unregulated exchange? You don't even have to name names. They're just not going to do it anymore. And in fact, what we're doing in our operating company is we're taking, because fortunately we have other positions that we're not in at FTX. Here's what we're doing. I'm just one investor, but I'll tell you. We're taking our positions and we're moving them to Canada. We're putting them into WonderFi and BitBuy. Why? Because it is the world's first, excuse me, it is the world's first regulated license issued to a broker-dealer exchange, all tied in one, under the order from the OSC. There is no optionality for commingling accounts. That doesn't happen in Canada. And in a really strange way, what I'm saying here is it's incredible that I have to go to another country outside of the U.S. to finally find a place where I can put significant institutional assets that's regulated. Our regulation has fallen so far behind that I no longer feel comfortable putting significant amounts into anything that is not regulated under the OSC order. So,
what kind of regulation, Kevin, could have prevented this from happening?
The same regulation that operates the BitBuy exchange in Canada. That's a public company. WonderFi is public. It trades in Canada. The BitBuy exchange is regulated.
I mean, FTX was regulated in the Bahamas, and they still didn't have the financials to make sure that they had the reserves in case of a huge run like this would happen.
In Canada, you can't lend clients' accounts out to other entities. That is not permitted. You can't leverage them. You can't commingle them. That's the whole purpose of having a centralized wallet, is that if you have to be compliant, you need reporting, and you have to market every 12-hour cycle. You can do that. Now, unfortunately, that is not what happened at FTX, even though the platform was robust enough to provide the reporting. But it was, at the same time, allowing for transfer and commingling of funds. You can't do that.
In your due diligence, did you know that they were doing that?
Under the OSC order. Say it again? In
your due diligence, did you know that they were doing that, commingling funds? And of course, they had a very close relationship with Alameda.
Of course not. Nobody knew. Nobody knew. And frankly, us that are paid spokesperson, and I'm in a lofty list of people, Tom Brady on down. Yeah, we're obviously not happy about this, but nobody would have done it had they known.
Did you get regular financial statements from them, and do you trust those financial statements?
We actually got our financial statements off the FTX platform every 12 hours. So what we would do is we would mark to market our positions along with our stock and bond and private equity positions every day, which is what we're forced to do to remain compliant. So we would mark to market, even though, as we all know, crypto token prices change 24/7. But we forcefully used the platform to look at every conversion that had happened, every position that was on, whether it was gated or not, whether it was locked or not, and we would take that every 12 hours. And that platform was very robust. It would allow you to do that on every single position with a complete history of the conversion record, as it should and as the chain provides. But no, we didn't know they were commingling accounts, obviously. And when the gates went up, the phone calls went around the world, certainly part of that scrum. And people were trying to figure out, what was going on here. And that took about 12 hours.
But did the close relationship,
we've talked to many other institutions.
Did the close relationship with Alameda Research, this prop trading desk, ever give you cause for concern? A lot of VCs that I know that decide not to invest in FTX said that was really the conflict of interest that made them not invest in FTX.
That's the Alameda situation. When you build a new blockchain, you basically want to get as many apps on it as you can. What gives value to Ethereum or gives value to Polygon is the fact that there are many, many apps being developed on it. Even Miston, which is brand new, coming out of the efforts of Evan Chung that's coming out of Facebook. He got funded immediately because of the potential of how many applications could come on it. But very often what will happen, and Alameda was being touted as this, you set up an institution that supports the development of a Serum or supports the development of a Polygon or supports Solana. And that was well accepted by many, many institutions, including all the institutions that you find on the roster at FTX. They understood that was what it was for. And indeed, if you look at what Alameda was investing in, was to support the ecosphere. So for many investors, that didn't seem untoward. And that may be questioned in the future. But more importantly, it would be the relationship between the accounts at FTX and Alameda. That's what's being alleged. That's where it's offside, and that's never going to be legal in any situation unless you sign a contract allowing it. And we're going to have to find out who signed what contracts as to whether that's legal. There's so much unknown in this situation, and as you pointed out wisely, that this is like an onion being unpeeled. But from my point of view, watching what investors do at the institutional level, this is going to help quite a bit in stabilizing what the rules are going to be, because crypto is not going away. And that is still of great interest to institutions that still won't invest in it because they don't have a platform to do it on. For me, it's moving under the Canadian order. I'm going to stay there until you can show me policy and regulation in the US. All of our assets will remain there because we've got a government, the government of Canada through the Ontario Securities Commission, controlling, watching, regulating every single account there. For all the, and frankly, what's going to happen is a lot of money institutional money is going to leave unregulated exchanges and try and find other places like BitBuy to put their capital, because what else can we do? We need regulation. We can't have a situation
But I'll just say this, Canada's not immune to this kind of thing. I mean, Quadriga CX also one of the biggest crypto exchange busts in the history of the industry.